Today, we're digging into 6 key sources, trying to make sense of some, well, really strange contrasts and pressures we're seeing across markets, companies, and even global politics.
Right. It feels like there's a lot happening just beneath the surface, even when things look okay on top.
Exactly. Our mission today is to unpack why that might be. So, okay, let's jump right in. We start with a big market contradiction. It's highlighted in the source. You've got the U.S. stock market showing, what, a 16.6% return year to date. Pretty strong.
Yeah, incredibly resilient, especially after that earlier correction. Corporate earnings look solid, too, often helped by, debt and buybacks.
But then you have Warren Buffett doing almost the exact opposite of what the market seems to be doing.
That's the fascinating part. He's sitting on this enormous $384 billion cash pile. I mean, that's huge.
So what does that signal?
Well, while fund managers are holding historically low cash levels and retail investors seem pretty much maxed out, Buffett's hoarding cash. He's selling. It strongly suggests he finds current valuations unattractive. He's basically betting against the crowd here.
Okay, so he sees risk. And speaking of risk, let's look at where concentration might be building now. This comes from the source fixed income concentration. We're seeing massive spending plans from the big tech hyperscalers.
Oh, absolutely. Meta, Amazon, Google, Microsoft. They're planning something like $400 billion for AI data centers. It's an infrastructure boom.
And that money has to come from somewhere.
It does, and they're hitting the bond and loan markets hard to get it, taking advantage of relatively low rates still. The amount of debt they're expected to issue in 2025 is, get this, 3 times the annual average of the last 10 years.
Wow, 3 times.
Yeah. So the concentration risk, it's shifting. It's not just about the Mag 7 stocks anymore. It's moving into the bond market indices themselves, meaning passive investment funds, like index trackers, are essentially forced to buy and hold this huge amount of tech debt. It kind of reminds you, maybe worryingly, of Ford and GM about 15 years ago.
How so?
Well, they dominated the debt indices right before, their bonds collapsed from investment-grade staples into distressed assets. It really shook the system back then. A similar kind of concentration is building now.
Okay, so potential risk building in tech debt. Meanwhile, are the banks holding up okay? Our next source, hiding the wound, suggests, maybe not entirely, banks used $50 billion in REPO just to close their October books.
Yeah, the $50 billion figure is, well, it's unusual. REPO is usually for very short-term liquidity, often in emergencies. That kind of level is more typical of crisis times, like during COVID.
So it's a red flag.
It could be. It suggests banks might be struggling to get funding elsewhere, maybe because of underlying issues. They're trying to mask things like credit quality worries or duration risk on their bond holdings. They're using central bank facilities to sort of paper over cracks, hoping rate cuts eventually bail them out. Borrowing time, essentially.
Okay, so financial system stress potentially hidden. And this is happening alongside some serious social pressures, right? Our source, Mind the Gap, talks about AI and jobs.
Exactly. AI is boosting efficiency, no doubt. But often, that's coming at the expense of human jobs. The layoffs announced for 2025 are already higher than any year since 2010, if you exclude the unique situation in 2020.
And who's feeling the squeeze versus who's benefiting?
Well, that's the gap. The bottom 50% of the population are getting hit by inflation and these job losses. Meanwhile, the corporate profits generated partly by this efficiency flow mostly to the top 10%, since they own about 87% of all stocks. That kind of growing imbalance, it's a recipe for social tension down the line.
Right. And on top of all that, we've got political issues. Let's start domestically with shutdown. This government shutdown is now the longest in modern history, 37 days.
It is. And what's weird is how numb the market seems to it. But the reality is a government that isn't functioning can't release critical economic data, inflation numbers, unemployment figures.
The very data the Federal Reserve needs.
Precisely. The Fed needs that data to set monetary policy properly. Right now, they're kind of flying blind while all these other risks we've talked about are bubbling up.
And internationally, things aren't exactly calm either. First, the source tariffs hearings. What's happening there?
The Supreme Court is hearing arguments right now about the president's power to impose broad tariffs using something called IEEA, the International Emergency Economic Powers Act.
Why does that matter so much?
Because those tariffs bring in around $30 billion a month for the U.S. They're also a key tool for leverage in trade talks, especially, with China. Losing that authority would be significant.
Which brings us perfectly to our last source, no deal yet. The U.S. and China seem stuck.
Very stuck. China's setting some pretty strict conditions just to even sit down and talk properly. They're saying things like, we won't discuss Taiwan or human rights or anything that interferes with our development.
That sounds like a hardening stance.
It does. It signals maybe a shift in how they see the power dynamic. Look, there's still mutual dependence. The U.S. needs China's rare earth minerals, where they dominate processing, and China needs U.S. consumers. But China seems increasingly willing to leverage its control over specific bottlenecks, like maybe less advanced computer chips, where they have huge production capacity. It's a real standoff.
So putting this all together for you, our listener, what's the pattern here?
I think the synthesis is pretty clear. You've got significant underlying risks building up quietly concentrated tech debt, potential hidden weakness in banks, serious social inequality from things like AI displacement, and political paralysis both at home and abroad.
Yet, the overall market seems strangely resilient, almost ignoring it all.
Exactly. It's like the market is numb to these fundamental pressures. The foundations look a bit shaky, but the building just keeps getting taller. It's
Yeah.
odd.
Okay, so here's a final thought for you to chew on. Given this market numbness, even to things like massive debt shifts and the longest government shutdown ever, what kind of event, domestic or global, might actually act as the catalyst? What could finally force these hidden interconnected risks out into the open?